My name is Mehak Begeman. I'm a fractional CFO and CPA and owner of RE Smart Advisors. We primarily serve clients in three main functions. We help clients with month-end accounting, also known as bookkeeping, tax planning, tax filings, and then fractional CFO services. In other words, it's cash flow management for businesses that are scaling very quickly, hitting seven figures and beyond, are hiring team members and need to be able to have financial systems to manage their cash. So let's get started. Here's the fundamentals. So I'm going to break it apart into three different sections here. Most real estate strategies, I think, fail and or clients are when I just had a sales call and the client said, this prospect said, I thought we were going to have all these losses from real estate. Come to find out, we weren't able to take any of the losses from our long-term rentals. I just was so caught off guard. I just thought we would be able to take the losses from it. So it's not a failure of the strategy itself, but it's the fact that whoever was doing tax planning with them didn't do a good job explaining how the same set of rules would apply to them as W-2 income earners. So we're going to set the stage. I'm going to walk you through that in detail. Of course, the classification of how IRS reviews income, active and passive buckets, and what that means and what you should know, especially as it comes and relates to being able to offset your active income from passive, quote unquote, passive income of real estate buy and holds. And the reason I say quote unquote passive income is because for all of us who are managing real estate, we realize that it's really not that passive. It requires a lot of attention to, putting tenants into your properties, rehabbing your properties, managing those assets. But from an IRC code section, rental activity is viewed as passive activities that are not subject to self-employment tax, which is why oftentimes you'll hear me say that passive real estate, like rental real estate, is considered passive from an income tax perspective. Double click on that and go in some detail around it. The third one is the foundational IRC code sections. Now, you may not be a tax professional and don't enjoy reading IRC code sections, but this is what I get paid to do, which is understanding, especially now with the new tax laws that have been rolled out under one big beautiful bill. Myself and my team spent a lot of time understanding what were the current rules, what are the new rules, what is changing, what do we need to be aware of with our clients. So if you like this stuff and would like to pay close attention, then you must know passive actually loss rules, section 469, material participation. I've got the Treasury reg cited there. Real estate professional status, often cited in a lot of different scenarios as it relates to tax planning. There's the RC code section there, number 3, and then number 4 is the rules. And these three kind of come together and form the foundation for all RE tax planning. So I won't go, I'll thread those through as we're going through the slides today, but we'll not go in detail of each of those IRC code sections just because they're difficult to read and difficult to understand. So I've kind of pulled out the main things that I think need to be understood by investors like yourself so that you kind of have the Cliff Notes version of these code sections. So number 3, we're going to go on here. So 3 IRC foundational codes. I just mentioned those. So let me go in some detail on this. Passive activity loss rules is something that I'm always constantly explaining to our clients, which is why I want to take a couple of minutes and go over what this means. So our typical client likely has either W-2 income, high W-2 income, or business income. Okay, so let's say the example of if you're a high W-2 income earner, let's say it's, husband and wife team, you've got 2 high incomes and you've got some rental assets. Like I said earlier, rental assets by default are going to be considered passive activities. So therefore, any losses, either actual or tax losses after depreciation, sit in its own bucket in the passive bucket over here. So think of active income over here and passive income over here. Generally speaking, these two buckets of income don't cross over and net together unless you meet specific tests. We're going to go through that next. Generally speaking, if you have high W-2 income and you have long-term rentals, you're going to have losses over here in your real estate portfolio, and you're going to have W-2 income that's heavily taxed over here. And generally, you're not going to be able to experience the tax savings that is often promised, especially from a lot of blogs and articles, bigger pockets, different platforms that will say to buy real estate so you can shelter your income. It's not an apples to apples comparison, especially when you do not qualify for real estate professional status, which I'm going to cover in just a minute. Actually, I'm going to jump down to real estate professional status and then come back to material participation. So the unlock in real estate tax planning is when one or both spouses meet real estate professional status. Okay. I want to go through the test on that. But the idea of passive and active income, now we can overcome that threshold if you're a real estate professional. You can take the passive losses, quote unquote, from the rental real estate, and you can apply it to all kinds of income as long as you meet material participation test. We're going to go through that as well. So let's keep moving through this because I think I've got a lot of good information here. I'm actually going to come back to this. Let me see if I've got, speed this up a bit actually. I'm going to go to, okay, so let me give you this visual. You've got passive income. This is going to be rentals, syndications, K1s from any funds, and then any activities where you don't materially participate. So let me draw that out a little bit. So let's say you have a friend who is starting a clothing business. Okay, you don't have time, you're running your own business, or you're doing your own job, whatever the case is, but you want to be part of that business, and you're like, hey, I'll put some money in, but you run the day to day, and then if there's any profits at the end of the day, this is how the payouts would work. Maybe not the most direct example, but this is what came to mind. In that case, you would be a part owner in that activity, but because you don't materially participate, any income or losses that you experience from that business are going to be passive. Okay, that's true for any syndications or funds as well. Your non-passive income is going to be your W-2 income, your 1099 income, if you are a subcontractor, flip income, any business income, even if let's say you own a cleaning business or a property management business, it's going to be business income, direct or non-passive income, and then rental losses. So we're going to unlock that. Why do these matter, right? So these matter because for us to be able to build off of the foundation of tax planning, we know for a fact that all RE strategies, whether you have short-term rentals, long-term rentals, flips, whether we're going to do cost eggs, we're going to group assets together. Underneath that, the foundation of that is, do you meet reps, and or if you file jointly, do you have a spouse who can qualify for reps by managing your real estate? Or if neither you or your spouse qualify for reps, then what are the exceptions that we need to implement? What is the gray area that we need to play in from a tax planning perspective? Because now we have to overcome a lot more of the hurdles to do tax planning because we don't have the ability to take all of the losses from rental real estate against your income because you don't qualify for reps. So that's foundational to tax planning and oftentimes gets missed. Now, if you do misclassify, if you take losses from passive activities like long-term rentals, what can happen? It's a failed strategy. There's a large audit risk out there, meaning we've seen, not personally, but we've seen other CPAs share notes with us, with myself, where a client took a large deduction, 6 figures. The IRS came in and disallowed it, and now they owe back taxes. So we want to have this strong foundation to be able to stack strategies off of. Okay, let's keep going on this. I'm going to cover a lot of information today. So here's material participation. There's 7 tests. We only need, so for us to be able to treat an activity non-passive, we need to be able to meet 1 of 7 tests. This is a basis for every short-term rental strategy. It often comes up, and also for reps. Just because you're a real estate professional. So oftentimes there's a myth out there that says you have to be a realtor to meet reps. You actually don't have to be a realtor to meet real estate professional status. As long as you have owned assets, or you maybe are not a licensed property manager, you're a co-host, but you're helping with any real property trade or business activities, which is improving, rehab, essentially construction, leasing, buying, selling, which is essentially a realtor, and you're doing that, to give you the test on this, over 50% of your time in real property trade or business, over 750 hours in 1 year in real property trade or business, which is essentially at least 15 hours a week, then you qualify for reps. Ideally, our clients who, without a doubt, qualify for reps are going to be our flippers, wholesalers, realtors, anybody who works in real estate full time. And you do have to be an owner in your activities for this to apply. So if you work for somebody else, it's not the same. But if you own your business, and most real estate agents are independent, then this strategy does work for you. I'm also going to cover in detail, because we have tons of clients who are high income that don't qualify for reps, So what do we do in that case? I will go through that. If that's you and you're watching this and you're like, well, this is not relevant to me, it will be relevant to you if you keep going along the journey here. And I will mention specifically what can be done for somebody who's high income without meeting reps. Here's the 7 test. I think a lot of these get overshadowed by a couple of the tests that most of our clients meet. We see a lot of our clients and their ability to meet the 500-hour test of material participation. I also see a lot of our clients meet the 100 hours and more than anyone else. This is very common in the short-term rental space. However, we have to document the hours that your cleaners, your handymen, your contractors, and otherwise any other people who are touching your property are spending, which is why the 500-hour test is, I think, a better test, especially if you're not able to track all of the other people's hours. I also see substantially all, especially for those of our clients who have the time and actually hands-on manage their short-term rentals and even clean some of the times. This is very important. And then the documentation, right? So just because you say you do, unfortunately, we'll notice we have 3 court cases we're going to cover today. Just because you say you do does not mean the IRS will hold that up in tax court should you get audited and or litigated. So credible hours, all hours claimed for material participation must be obviously accurate, verifiable, and then it needs to be a contemporaneous record. So as things are happening, and you could be 2 weeks behind or 3 weeks behind, but essentially you'll notice in the court cases that we cover today, spoiler alert, that when you are creating time logs under audit, generally speaking, the tax courts are not going to rule in your favor. I don't even remember what I did last week, let alone what I did 5 years ago or 2 years ago or a year ago. There's just no way. A lot of our clients are automating this and using apps like Clockify or Reps Tracker and taking the human error out of this. Systems and processes is what it comes down to. It is a labor of love to track all the hours. It's not exciting, but it must be done. Let's talk about what type of hours matter in this case. This is a question I also get all the time. So routine admin tasks like bookkeeping, answering emails, scheduling, they rarely count towards material participation. So operational involvement is what we're looking for. So if you're in real estate, whether you own long-term rentals, short-term rentals, mid-term rentals, think anything that a property manager would do on your property, including marketing the asset, leasing it, looking through applications to qualify pre-screened tenants, showing the property, cleaning the property, stocking inventory, things of that nature. Those hours count, but bookkeeping, talking to your CPA, talking to your attorney, asset management hours generally will not count. And we know this from court cases. No recreated logs. Common theme that we see with our court cases that we're going to cover today is that we have individuals that under audit were creating logs that were vague. They really weren't detailed. They were vague and not detailed. And it's hard to depend on these type of logs, especially when they're created after the fact and not created as work was getting done. And then IRS enforcement, if hours cannot be proven with proper documentation, then the IRS within its reach will disallow the claims, the loss is taken, and then therefore you can owe a whole lot in back taxes, penalties, and interest. Not a good situation. I mentioned this a little bit earlier, real estate professional status, the big unlock with the 50% rule, and let me slow down on this because it's so important. 50% rule, which is where W-2 income can get problematic, is we're saying the rule says over half of your time, of your total working hours in a year must be from real estate or related trades. So like I said, rentals, development, brokerage, construction, maybe your acquisition of real estate, buying and selling a real estate. This is the first major hurdle, the 50% rule, which is where we find that if you have a very demanding W-2, or you work full-time for somebody else, it's very difficult to overcome this 50% rule. Can you overcome it? We will actually see a court case in which we will find that this taxpayer was able to overcome this rule, but I will walk you through what exactly this taxpayer did to be able to hold up under audit and not lose in this tax court case. 750 hours minimum, which is about 14, 15 hours a week. Of course, it ebbs and flows, but these activities, continuity of activities, ongoing, which is why somebody who's generally doing this for their day job, they own a small business, they're a realtor, they're flipping houses, they're a wholesaler, they're a full-time investor, they don't have any other income, or maybe we have a spouse who makes $500,000 and we have a partner, their wife, their husband, who is not working a traditional W-2 job and is managing all of the assets, in that case, the spouse can presumably qualify as long as the hours are met. Material participation, honorable mention here, we've talked about that in detail today. One of 7 tests must meet at least one of those 7 tests, either the 500 hours or substantially all, or 100 hours more than anyone else. There's 7 tests, so you have to just meet one of the 7. What does reps unlock for you? And for some of our clients, guys, I actually have an amazing story on this. We have a client, a couple that has worked with us for the last couple of years. And a couple of years ago, we'd set a target, or they had set a target for bringing his wife home. And essentially, she went to part-time at her W-2, and then she's now this year going to be full-time in real estate. And part of that strategy was, can we qualify this individual, the spouse, for reps, and is a tax savings equivalent or more than what she would make after she pays taxes on her W-2 income. Of course, the portfolio has to produce enough income for them to be comfortable as a family. But if reps is like a qualifying differentiator in order for this individual to be able to quit her W-2 and come into the family business, their rental portfolio full time. So what this is going to unlock for them is loss conversions. So wherein their long-term rental losses would be passive, now they can be non-passive. Grouping flexibility, we can actually group certain activities together that we previously would have avoided because the losses would get suspended because they were passive. We can now take some aggressive depreciation on some of the assets where we've previously held off because we know that we wouldn't have been able to offset the other income. And now we can actually unlock some other planning, learn some planning that otherwise would be not applicable because of the passive actually loss rules. Okay, I'm going to cover 3 court cases, and I really enjoy court cases because they seem like stories and they're easy to digest more than the IRC code sections. And it also holds validity in that we know how the court has previously ruled. So we know that how future cases might be ruled. Essentially, if you look at the Supreme Court, there's very few tax court cases that the Supreme Court would even rule on, especially if something has already been settled in either a lower court or if there's enough guidance out there, they will not even take a new case. So the fact that we have court cases tells us that this was litigated, that there's enough material out there now. There's several court cases that we should be able to look at these court cases and infer how the IRS and/or tax court would rule should you be in a similar situation. So this first court case is Harnett versus Commissioner. This is a couple who tried to combine their hours and meet real estate professional status, essentially take non-passive losses from their rental real estate. Basically highlighted the pitfalls here. So they tried to combine hours. Now, can couples count hours together? Yes. However, it has to be different activities, right? So let's say if if one spouse is in charge of getting the asset listed and leased and is screening tenants, but the other spouse is doing the rehab and actively managing repairs, those are 2 separate activities. Those hours can count together. But can you double up on hours when you're both kind of leasing, walking through the property or walking through Home Depot? No, you can't do that. Neither spouse individually met the test. And essentially, in this court case, and 90% of the time, we see that the taxpayer loses when they have W-2 income and they can't individually qualify. Both had W-2 incomes, and reps was denied. The main key takeaway here was be careful when spouses are pooling hours together. Essentially, the key takeaway here is that can spouses pool hours together? Pool is like maybe a bad word here, or not the correct word. Can they count time towards activities they individually perform? Yes. Can they both claim hours on the same property? Yes, but not the same type of work, right? So if you're both listing the asset and you're sitting at your desk and doing it together, you can double up the hours. So here's the next code case. This is a couple, Moss versus Commissioner. So in this case, perhaps I'm mispronouncing their last names, I apologize, but in this case, this was an attorney who had a heavy workload and they claimed reps, right? So they were claiming reps, and we'll see a positive court case here in just a minute, but in this case, here's what did not hold up under audit. It was that the logs were not credible or consistent. So I think the courts went even as far as pulling tenant logs and vendors that were servicing the particular properties that they were claiming reps on. The hours were implausible given the workload at work, your W-2 income. And essentially, reps was denied. And the two common themes here was that the logs were not contemporaneous and also they were inconsistent and not detailed. And in totality, if you look at your work week, even if you are somebody who works a lot of hours, at the end of the day, there's only so many hours in a given day for you to be able to achieve all of the hours between your day job and real estate. So here's a court case. Here's a positive court case that we can also model after, in which case Hillman versus Commissioner. Hillman actually was able to defend and in tax court and upheld her rep's status. So in this case, this was a W-2 income earner who claimed reps, and the taxpayer won in this case. So here's what's different in this particular court case. The logs were credible and consistent, meaning there was detailed logs. And I think this third bullet kind of speaks to it all, which is she was actively doing the maintenance, the repairs, the leasing, and she was documenting it all. So she was literally hands-on managing her asset. And perhaps that is the differentiating factor. If you kind of step away from this, the key takeaway is that do you have a property manager? Do you have a co-host? Or do you actively manage your real estate? Meaning you show up and walk tenants through the leasing process and you check out tenants, and you perhaps do some of the small maintenance, maybe big issues you outsource, but some of the small stuff you just take care of yourself. And the IRS did try to disprove the hours in her case, but because of the detailed record that she had kept, they were not able to uphold it in the court systems, and therefore her records did hold the audit risk, and she was able to win this case. So if we were to highlight key takeaways on this, I'm actually going to backtrack here. Actually give you a spoiler right here. So here's the common themes, right? So invalid hours was a big one. Demanding W-2 job, we saw that with the second court case. And then we often see that reps was denied unless we had the accurate documentation and legitimate hours that were detailed. So can you qualify for reps? Should you use that strategy, especially if you've got a spouse who does not have a day job and primarily manages your real estate? Most likely, but it comes down to being able to prove that under audit, which can be done by keeping clean detail logs. So if you've been hanging on with us today and you're like, hey, I am a high W-2 income earner, I don't meet reps, what are some ways that I can offset my earned income, even though I'm not able to yet invest in full or work in real estate full time? So if you're high income, W-2 income, and you need some exceptions to the rule, this is where this probably applies to you the most, and use cases also where we see the most amount of tax savings by structuring things this way. The most common one, I would say, especially with the boom in the short-term rental space, has been high income owners that are investing in the short-term rental category, that specific niche. The rules are strategic in that for a short-term rental to be a qualifying non-passive loss, the average stays have to be 7 days or less, and material participation must be met. Meaning, if you're a physician and you have a property manager that deals with the day-to-day of your short-term rental, you're most likely passive in that activity. That's one of the reasons why we have physicians who sometimes will elect to buy something locally so they can service that property and meet the material participation hours to be able to play out this tax strategy. The 7 nights or less has been becoming more and more difficult as market conditions are changing, and a lot of owners are starting to convert their short-term rentals into midterm rentals, 30-day stays, and so on and so forth. I see that sometimes clients miss out on some tax savings because they're trying to break even on their debt service and therefore are making a business decision, which makes a lot of sense. But if you invested in an SDR with primarily the target being tax savings, then let's work closely on this to make sure you actually are able to capitalize on those tax savings. Number 2 is facts and circumstances, meaning not everybody has the ability or the privilege to bring a spouse out of a W-2 job for them to be able to qualify for reps. When I'm doing this in practice, practically speaking, I'm looking for a number of assets, and also does that, is it one asset or is it 15? Like, just think about facts and circumstances. It makes a material difference whether you have a portfolio of assets that your spouse is managing or you, the spouse, are managing, or is it one asset, right? How much time could you potentially spend with a long-term rental that's relatively autopilot once you get a tenant in there, right? So the facts and circumstances do matter when we are placing the strategy with our clients and thinking through strategically qualifying a spouse for reps. Number 3 would be primarily high income earning couples that are 500K plus, who are now, a lot of our clients are now looking at oil and gas working interest, because the main difference here, the best way to think about this, is that oil and gas creates first year losses similar to real estate. If you were to do a cost segregation study on a real estate asset, for example. However, oil and gas is different in that you don't have to overcome passive actively loss rules similar to real estate. So oil and gas working interests actually are not filtered through the same passive actively loss rules, because none of our clients are actively on site, on the oil rig at all. It's a capital interest in some sort of a joint venture, and you're able to take non-passive losses from the fund. So if that stands out to you, if you're in that income category, 500K plus, we have some clients in the 1.2, 1.3 onward range, then this can be a very meaningful strategy for you. And then number 4 is arguably one that has to align with your business interest and what naturally you're doing, the direction you're going. But some of our clients will strategically go either acquire or start an equipment heavy trade, whether that is equipment renting. And there's actually another strategy. You don't have to literally own equipment renting yourself. There's, similar to oil and gas, you can fractionalize your interest in equipment renting from a tax perspective. But we have some clients who are naturally in blue collar businesses that are equipment heavy, and they might have some real estate over here. So we can couple those strategies together and when I say equipment heavy, I'm thinking what type of businesses, let's say, for example, car washes, equipment renting, laundromats, different activities where you're very heavy on machinery and can accelerate depreciation on 5-year assets in certain years when it makes sense. Now, in this presentation here, in this live, I'm not covering anything that relates to recapture or cap gains. We're going to do a separate conversation on that. But just because you can take a first year benefit does not mean you should. That's where tax planning comes into play, and the timing of when deductions are taken. That's the basis of tax planning. This is foundational to be able to think through these things in detail. So here's a short-term rental exception. I spun through this quickly, but let me highlight this. So short-term rentals they're not a trade or business. They're not passive real estate. They're kind of the gray area in the middle. Think of this as an inn or a hoteling business as long as certain rules are met. There's 4 that I'd like to highlight here today. Under 7 days, average guest stay is non-negotiable for the short-term rental strategy to play out the way we intend for it to play out. Non-passive in that if it was a mid or long-term rental, and again, this conversation doesn't apply to you if you meet reps, right? If you meet real estate professional status, you don't need the exception. But if you're a high income W-2 earner, then you do need an exception. Otherwise, you would have passive losses from real estate. So in this case, you can take non-passive losses from your short-term rental to offset business income, W-2 income, and any other income that would otherwise be considered non-passive. See how I'm not saying active, because I think it's confusing. Non-passive is essentially business income. There's a slide that we went through earlier in the presentation on what is considered active income. Now, material participation, like I mentioned, does apply, meaning you can have a co-host or property manager, boots on the ground, that's kind of doing all the day-to-day. Essentially, at that point, you will be passive, because if you look at the core of that test, it's basically looking to see, Do you engage in that activity, or is somebody else managing it and you're essentially the capital partner on it and don't do any of the day-to-day in that business? So for high income earners, this is a huge opportunity. I think it's very well marketed, and a lot of our clients are in the short-term rental space. Talked about one qualifying spouse. I sometimes like doing where maybe a spouse is not ready to fully quit their day job, but if they have the flexibility to be a subcontractor, take a 1099 income, and reduce their workload to not be full time, I find that a good in between to be able to bridge the gap. Something parallel that's more aligned in real estate tends to be a huge unlock for our clients, especially if they were inclined that way to begin with. Oil and gas, wanted to give you guys a slide on this to say it's non-passive by statute. Losses can offset W-2 income. It is high risk. It is very high risk, meaning with any investment, you can lose your original capital. But of course, with oil and gas, even more so. So we spend a lot of time with our clients understanding what the offer actually is and what the risk is before we move forward on it. And here's a slide on equipment heavy trades that we were discussing. We do have a client who bought a gas station a couple of years back because they had a large cap gain that was coming through. The timing on that was extremely important. We also see there's something not mentioned on here, but I should mention that's a more parallel acquisition that we see with our clients, which is storage units. So a lot of our flipping clients will target specifically storage units for the same exact conversation that we're having here, which is although they are a lot of the self-storage units that we have, they're self-storage, they're very tech heavy, but they depreciate very well, very nicely, and actually create a lot of tax savings for our clients. So I covered a lot of information here. So here's a key takeaways, right? So let's start with foundation first. So hopefully now we've covered what is active, what is passive. If you meet reps, you've unlocked a lot of the passive outside loss rules and can take those against all types of income. If you cannot meet reps, then you need to play in the space of exceptions. So that's one. Two is, are there strategic things you can do, especially if you're married filing joint and your spouse's income is comparable to what the rental real estate is bringing in? Or can you scale to a level where one spouse can then take over the active management of your real estate portfolio to be able to unlock reps? A lot of our clients already meet reps if you're flipping houses and that's your main income, or you're wholesaling. So it doesn't really apply to those type of clients. I think the strategy on their end looks on that type of a client looks different than if you're trying to unlock from 500K W-2 income to how do we stop getting hammered on our tax bill. We talked about the three main IRC code sections. Feel free to go back and review those. I'll mention them here. Passive activity loss rule is a big one. Real estate professional status, and then material participation tests. And then think long term, right? So one-off tactics, it might give you a first year benefit. And I mentioned that too, which is just because you can do a cost segregation study on an asset, should you do a cost segregation study on an asset is that question alone has very different outcomes depending on what else is happening in your tax year in a given year. Meaning, did you sell an appreciated asset? Are you down overall in income? Are you transitioning to self-employment? Did you have a massive year, like a really big tax year and you owe a lot in taxes? It just completely depends on facts and circumstances of your tax year. And the answer varies between clients quite a bit. So here's my ask, which is if you're paying a lot in taxes, 50K, 100K, and not just actual cash at April 15th, if you look at your pay stub year to date, we're almost at the end of the year, and you look at your number, the year to date total column, and let's say you make 250 and you pay almost 22 to 25% of that into the tax bucket, or you are self-employed and you're writing, $30,000 checks to the IRS come April, then you're fundamentally missing tax planning. So now, we're coming up on year end. This is the time to get in front of this. At least how I just had a call before I did the live here today with a client who is feeling very unsure. A lot of things are changing. They're transitioning from W-2 to 1099 income. They're like, hey, I just want to know, what do I need to pay in for estimated taxes? And my feedback to them was, that's just baseline. Like, that's what you need to know before we can even do tax planning off of it. So let's understand baseline. Then let's start to pull on the thread of what they have a new asset coming on. They have some pre-tax investing they would like to do, but we just don't know by how much. And we're not going to know by how much until we go map it out and say, here's baseline. If we did pre-tax investing, it changes your tax bill by X, reduces your effective tax rate by however much. And then with the new asset, same question, should we do a cost segregation study on it? The answer is I don't know. I don't know unless we go map that out, which is what we're going to do next steps for them. So if you want the same level of clarity in your business with your assets and your income, reach out to us. We'd be happy to offer you at least a free consult so you can see what it looks like to work with us and see if we're a good fit. Thanks, everybody, and have a good Thanksgiving.